Ever wonder about the state of the market today? How about tomorrow? Or even a decade from now? The current market landscape paints an intriguing picture, one that's teeming with possibilities yet fraught with potential pitfalls. Firstly, we're staring down the barrel of a probable significant market decline in 2025. The exact timing, however, remains a mystery. Current stock market valuations are reaching for the stars, with metrics suggesting potential negative returns over the next 10 years. Meanwhile, the bond market is flashing warning signs via rising yields, even as credit spreads stay tight. The Federal Reserve is in a bit of a pickle, wanting to cut rates but constrained by concerns about inflation. It's a challenging balancing act, to say the least. And let's not forget the dominance of passive investing, which may be nearing its final act, suggesting a potential encore for active management. Moving on to portfolio positioning, Fleckenstein remains heavily invested in precious metals and select mining stocks, viewing gold as a shield against poor central bank policies. He's also taken targeted positions in companies that can bloom regardless of the economic weather. Interestingly, Apple shorts serve as his hedge. New Harbor, on the other hand, is maintaining a modest long-term bond exposure of around 7 to 7.5% and is heavily weighted towards short-term treasuries at 34%. They are open to potentially increasing long bond positions if prices tumble further, with emphasis on position sizing and risk management. However, this market landscape isn't without its risks. Government debt levels and deficit spending continue to be worrisome. The bond market might not allow easy inflation of asset prices moving forward. The probability of a significant drawdown is historically high based on current valuations, and the sequence of returns risk could spell disaster for retirees if major losses occur early. So, what's the game plan? It's all about focusing on position sizing and risk management rather than making big directional bets. Protective positioning is worth considering given the extreme valuations. There are still opportunities to be found in companies that can grow despite the economic conditions. Running detailed financial planning scenarios is crucial given the current risks. And when making allocation decisions, both the probability and magnitude of different outcomes should be considered. In summary, the tone isn't apocalyptic, but it is cautious. The emphasis is on careful risk management and realistic return expectations given the current market conditions. It's about being prepared, being proactive, and above all, being pragmatic in navigating the market's choppy waters.